And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The ETF industry is closing out 2023 with inflows into both stock and bond funds. The big story, though, has been the emergence of actively managed ETFs, which have captured about a quarter of all the flows this year. Why is this happening, and will it continue into 2024? Let's talk with Brendan McCarthy. He's the managing director at Goldman Sachs. He manages the newly launched Goldman Sachs S&P 500 Core Premium Income ETF. It's a lot of words there. And the NASDAQ 100 Core Premium Income ETF. Both of them are actively managed, and they use an options override strategy to generate income by selling call options. We'll explain all this. Tim Seymour is the founder and CIO of Seymour Asset Management. He's a research provider for the Amplify International Enhanced Dividend ETF. That's another actively managed strategy. He's an expert in international investing. We'll talk about that. And Todd Sohn is the ETF and technical strategist at Strategic Securities and all-around grand poobah on the ETF business. All right, Brendan, Goldman just launched these two actively managed ETFs a few weeks ago. One centered on the S&P 500, the other's on the NASDAQ 100. Both use this override strategy to generate income by selling call options. So that sounds fancy. Explain it for the viewers. Assume that they don't quite understand what you're doing.
Sure. And thanks, Bob. And you mentioned a moment ago a lot of words, but in those words were core and income, and that's pretty important. But these are buy-right strategies, right? And as the name suggests, there's two key components, the buy and the right. The buy is simply buying a diversified portfolio of stocks. In this case, we're buying the index. We're buying S&P and we're buying NASDAQ for each respective fund. The right, where we're selling calls, we're writing calls on those index ETFs in order to generate income, right?
Right. So the active part of this is where you're buying the options, right? Now, how do you determine what options you're actually going to buy? That's your choice, right? That's the active part.
Exactly.
How does that happen?
Yeah, so this is really the best combination of index and active. The index is the underlying component. The active is a dynamic overriding strategy, right? The options we're using options in ETFs. We're writing options on Qs and SPYs, right? And that's very purposeful so that we can manage the basis of it all.
I want to get to the core of this. You're not writing options on all 500. How many are actually writing options on, and how do you determine what that number is?
Yeah, we're writing options on SPY and triple Qs.
Okay.
That's it. And we're doing that purposely.
Not individual ones, though.
Not individual.
Okay.
Just
important
the ETFs.
distinction.
Exactly.
Okay.
Exactly. And that allows us to manage the basis.
Okay. I want to just move on here. You're looking at the S&P. By the way, you look at the core holdings here. Look at this. I mean, there you go. This is the S&P 500 here. So again, the key strategy is the options overlay that you're doing here. And here's the NASDAQ 100. If this doesn't look like the NASDAQ 100, you're not paying attention here. That's pretty close to what you're actually doing. Tim, you provide, I want to move to you, you provide research right now for the Amplify International Enhanced Dividend ETF. This is actively managed. It's really the same contents. You use a call writing strategy, but this time you're doing it with international stocks. So explain a little bit about how this works.
Yeah, and as a guy that's been investing in international and EM most of my career on the hedge fund side, what I love about this strategy is, first of all, we're not tethered to Eurostoxx 50 or MSCI Global. We can pick best of breed companies with balance sheets that we think are pristine. Again, companies similar to other div strategies where we want companies that are growing their payout levels, and we want to be able to then have this tactical call writing approach, which we think also minimizes volatility. And it's not just writing calls on every stock in the portfolio. But ultimately, it is about delivering return. I mean, the strategy's total return is a little under 16% year to date. Many people look at international as similar to U.S. equal weighted, and it's outperformed the RSP or pick whatever equal-weighted ETF over from inception by almost 7%, and that was back in September of 22. So international is not where everybody needs to be with all their assets, but it's a time between Fed policy and dollar peaking that I think international active works.
And I'm looking at your core holdings here, and this mimics the international index that you use with.
Right.
I see Petroleum Brasileiro, Petrobras,
Petrobras,
Mitsubishi, Banco Bilbao, Heineken. These are all big, well-known companies here. Use the same strategy here. You're buying call options on an index, right?
Buying call options on the individual stocks. And to be clear, every stock in the portfolio, for people that are worried about being invested in far-flung places, these are all in ADR form. And if we don't have the liquidity in the underlying, especially even in the options markets, we don't have to be there. But again, all these are ADRs. They're big balance sheets. They're big global companies that we think ultimately fit the criteria, which is that they're growing their payout levels and they are a more conservative approach to getting your international.
So there's a distinction, though, here between the strategies. You're using the S&P options and NASDAQ 100 options. You're using individual. How do you decide which stocks you're buying options on?
If you think about a lot of the stocks, think about the move we've had in Japan. Think about some of the dynamics with the Japanese banks once the BOJ said that they were going to end YCC. A Mitsubishi, which is, I'd argue, the JP Morgan of Japan, had a really big run. And sometimes that upside vol is really interesting to be writing calls on. So we're tactical. It's not universally taking the entire portfolio and writing calls against it. In fact, that's
and
the
I want to
whole
make the same thing you have in common is you're selling calls to generate income, and there might be a tendency here, Brendan, to go for whatever you can do to generate the most income, to have a distribution that's high. But my understanding, talking to you, that's not necessarily the goal here. Your goal is not necessarily to generate the highest level of income. What is
correct, right? So we're trying to do three things here. First and foremost is give you that core exposure, right? That's very purposeful because that's at the heart of many client portfolios. So core S&P and NASDAQ, right? But secondly, we're trying to target a stable yield, right? Income investors, they want to know what they're going to get, right? So part of our strategy is to really be very consistent with the income we're going to generate. The third part, though, and this is really important, a lot of buy-right strategies cover the whole portfolio. Bob, the active part of ours is we're managing the coverage ratio, right? We're doing that so that we can leave some of the portfolio uncovered so that income investors can also benefit from capital appreciation.
Yeah, and the key thing here is in terms of what kind of options you're buying. You're buying near in the money options, or you're not going out a year now.
No, we're focused on at the money.
At the money. Okay. You two, where are you?
We're somewhere between 3 to 6 months, but in some level, again, some of the near-term stuff actually pays you more in terms of the implied vol.
And I want to note, free ad for you, Amplify, who you work with, also has DIVO, D-I-V-O, which is an actively managed ETF that provides income by selecting stocks from the United States. And this is, by the way, a dividend strategy.
This is the sister strategy, international version, the exact same approach to a $3 billion plus ETF.
Right, but you use a dividend strategy here, correct?
Well, the approach here, again, is total return. The distribution yield is around 6%, and it continues to be a big part of what this fund is doing. But again, in terms of the performance, I'll let the audience and the investors think about how they frame international vis-a-vis both U.S. and equal-weighted, market-weighted. But the point is that if you think about the exposure you're getting with a lot of big established international companies, you're talking about industrials, you're talking about banks, you're talking about resource companies. We have a view that we're in an energy super cycle. If you look at the big integrated oil companies in Europe, a Total or Royal Dutch, their break even for their div is even 15, 20% cheaper than Chevron and Exxon. So part of this is finding companies that we think are truly best of breed companies, growing payout levels. Part of it is finding those companies that we actually think are well positioned and are cheap relative to their peers.
You've been an international investor. I've known you for a long time, and yet it's still underperforming this year on an index basis, even in Asia, even Europe. Still, how do you keep people interested when you have consistent underperformance?
No, fair enough. And look, I don't expect that people are running out to put 30% of the portfolio on the equity portfolio in international. But I think, and in fact, if you look at international and EM ETF allocations, we are probably on a relative lower ebb than we've been at other times. I think the two things you look at with international for the next 12 to 18 months are, look, I think the dollar is sniffing out Fed policy. I think going into 23, everybody thought the dollar was going to be very weak. In fact, it's caught a lot of people off guard. I think it started to give ground. I think the Fed, wherever we are with higher for longer, Fed policy, I think the dollar is sniffing out, and it's lost 4% since the beginning of October. That's a great backdrop for international investing. It's not your only reason, but I think, again, pick your allocation, and this is a great approach because it's conservative, it's best of breed companies.
You've been very patient sitting over there. This is the grand poobah, my friend Todd, who likes to opine on the ETF businesses. What do you think about this? I mean, the ETFs are historically associated with passive investing. You all know that, like going in the S&P, but we're talking about active here. Why is active management having a moment? And there's a very specific kind of active management, actually.
Yeah, it comes down to, I think, a few different items. Number one, money's going to ETFs. It's leaving mutual funds. So if you're an active provider, you have to have the vehicle now. And I think you're seeing that from certain issuers, right, who are out there. Secondly, you have 5 stocks that are 25% of the S&P 500. That is great for passive, but if you're a little concerned about those stocks maybe coming in, you're going to want to have a hand on the wheel. And then third, it's not traditional active anymore. It's not the old school, back in the day, call on the hotline, here's a good stock. It's income, right? I think income might be the word of the year for 2023, given the amount of flows that have gone to income products, given the amount of flows that have gone to money market funds, right? I think you have a large cohort of investors who are approaching retirement, but they just want to keep getting that paycheck to pay off their monthly bills, whatever it might be. So it's a big shift.
Well, see, that's a crucial distinction. Why I think this particular kind of active might have a little more legs here. This is not your grandfather's investing. This is a very specific. You're not picking stocks so much here. You've got an investing strategy that's a little different. So do you believe there's enough investors that are willing to buy these products? Has the investing community become that conservative? Or they're getting old and they want the income?
I mean,
you see
more sophisticated, I would argue.
Sophisticated, smarter, and then just the amount of money that is ingrained from those who have grown up over the last 50 years. It's a lot of wealth they've been sitting on. And they may not want to leave their entire equity exposure. So they may say, let me dial it back and still get large cap or small cap exposure with that income. And then for international, I think it makes a ton of sense. International's been terrible. And so at this point, you have to unbundle your international. Don't buy the ETH, don't buy EM, buy specific countries and then specific stocks. And along with the covered calls, I think that helps there too. So I think that's the future of active.
No, you can't invest in a bad neighborhood, in fact. That's kind of the point. And I mean, like, look at people who've been trying to make money in China, and it doesn't necessarily work. And this argument about, like, the Magnificent Seven or 8 stocks being 30% of the S&P, I'm not saying it's tomorrow. That, to me, is peaked. And I think that's going to really benefit international.
There is, so here's the cynic in me. I follow ETF flows. ETF was a popularity contest. It becomes that.
Yeah.
And we saw this with pot stocks. We saw this with all sorts of things in the last 10 years that have come and gone. They closed the meme stock ETF a little while ago. Remember how hot that was? So there's a plethora of these covered call ETFs that are out there. Goldman, which has got a lot of money behind it, is now in the game, which is why I'm having you here to talk about it. But we've seen filings from ProShares around this recently, iShares. Who else? Roundhill, Defiance have come in. There's a whole pile of people coming in. Is there enough? Is there enough scared baby boomers out there?
It's very reminiscent of me of a few years ago when you had the success of ARC, and then all the issuers started coming out with innovation and disruption. It doesn't mean it can't work, and everyone here can't be successful, but the pie is going to get smaller and smaller until the next craze comes along, whatever that might be.
Yeah.
Bob, I think you look at this is a solution, right? And a solution for who? We talk about boomers. There's $11 trillion in IRAs. There's about $850 billion expected to roll over. That's a lot of money coming into from boomers, from people that argue that conservative end of the investing spectrum. This type of solution helps them with RMDs, helps them manage their expenses. So I think more and more with active management, it will be the traditional, the stock picking stuff that we've talked about, but it's also these type of products. They're providing solutions, right? And you can use derivative type of products that can generate income and provide a solution.
This makes absolute sense to me. You're sitting there. If you're a Goldman Sachs, you've got an enormous potential investor base there, and the old let's pick stocks doesn't necessarily work so well. You've got a different kind of active solution that's out there that generates income. And I'm a nervous. I'm almost 70 years old myself. I'm the heart of the baby boomer generation. This makes a lot of sense to me. I must say, here's my one pushback on this. You have to kind of believe that you're going to get subpar returns for a long time. I personally am in the game. I'm planning to live till 90, so I'm almost 70. I got 20 years. If I had a down year like last year, it's not going to matter in 20 years from now. So I tend to just stay long on this. I'm a Jack Bogle guy. I tend to stay long on this. How do you convince those people that are a little nervous to buy a sort of annuity? I'm not saying these are annuities. They're quasi protection.
Income.
That's
I mean, there's nothing wrong with seeking out income in an active alpha generating strategy. And I think that's kind of the point. And I would make the argument that the advisory community and self-directed investors are so much more sophisticated and actually need to deliver something more sophisticated. And that's the good news. This isn't, passive ETFs have had a great place, but again, active ETFs have already exceeded, last year by what, 20 billion or so in terms of their allocations. That's going to be higher next year too. And I think that approach to generating alpha.
Well, maybe. Remember, these strategies, they work in a very specific environment. We talked about this earlier on the show, folks. Call writing strategies are one of the most popular actively managed strategies. They work great in an environment where the market is sideways or down, but not so much in an up market like we're experiencing now. Can we keep, with all of these new ETFs coming to market, are they going to find an audience if the market keeps rising? It's a harder play. It's a harder play.
Look, I think that is the point, like 100%. Because there's a lot of flavors of buy right strategies out there, right? But any one of them, what we really want to do, we want to deliver income on a portfolio that's appreciating. Yeah. This is where the active overriding strategy comes into play, right? Because you don't want to be fully covered, right? Because then you're not going to participate in the upside, right? So the active management is really on that coverage ratio, and investors, active investors, really want to be managing that so that investors like yourself, the folks that are 70 and waiting for income, right? You also want your portfolio to grow.
By the way, if we're learning on cable, national cable, financial news that Bob is almost 70, you can knock me over the feather.
Okay,
I mean,
fantastic.
I figured you were talking about 50 more years.
There you go. Well, I was at the Bob Dylan show the other day, and all the wheelchairs rushed the stage, and all the canes, we came up, waved our canes in the air, and
not apparent.
Yeah. Delete that from the show, please. I want to go back to the dividend ETFs, because here's another strategy that's had a tough time this year in general. Dividend stocks and ETFs, they've underperformed the market all this year. The biggest dividend ETF, iShares, DVY.
Yeah, there's a whole host.
It's DVY, right? The dividend one.
Yeah.
Yeah, iShares. Yeah. It's down like 5% so far this year, with the market up 18%. And we had all-in bets on utilities, kind of fizzled. Now they're coming back.
Wrong constituency in this type of environment when it's big tech. Right? And I get dividend ETFs, it's more income, but there's such amount of flavor out there for dividend ETFs. You need to understand what they're looking at. Is it growth over the last 5 years, 20 years, 50 years?
There we are. There's the S&P versus the
if you're
DVY.
buying a dividend ETF and it's heavy on utilities and staples when rates are 5%, that doesn't make any sense.
Or going from 4 to 5.
Yeah.
I mean,
exactly.
and I would argue, and I think Brendan was echoing this point, which is that you're not going for the dividend. You're going for a portfolio of companies that actually are targeting, and those companies as a subset are generating higher payout levels.
Point out they outperformed in 2022, by the way.
And if you were chasing dividends, owning AT&T and Verizon, and I mean, we don't need to pick on those guys, but that's, to me, and we do this on Fast Money every night. If you talk about investing, chasing dividends just on individual stocks, you lose that in one day. I mean, it's not so I think the approach in ETF land to find an active strategy that is looking to find companies that have a dividend profile and a free cash flow profile, a balance sheet, frankly, that's not worried about paying the next dividend, is really what this is about. So hopefully the active strategy, the alpha is added by picking those companies, but that the structure is that you're not necessarily having to pick stocks all day long. There's actually a framework.
So what would you say, Todd? I think this is candidate option overwrite strategies, whatever you want, buy right strategies, is probably a candidate for the big ETF trend of the year. Is there another trend? You're the grand poobah here that really stuck out to you this year?
I think it's that. I think it's short duration cash-like vehicles. And I also think I would pay attention to small caps. I mean, that's a 2024 story in that real active management, the traditional.
There's no money going into small caps.
Small caps are flawed. Right, too many regional banks, too much boom and bust biotech. That's where you should focus on traditional.
Yeah, I'm not talking about what you want to have happen, though. I'm talking about where the money actually is going.
That's next year.
Yeah, okay.
This year's been all about short duration. Right, cash-like vehicles. I mean, money market funds aren't an ETF, but.
All right. Would you agree? You're a long-time ETF guy.
Just under the hood, though, in the month of November, small caps made an appearance. If you look closely, there's activity there, and I would, the last 5 weeks, Bob, we've launched 3 new active products. 2 are the premium income. 1, believe it or not, is also our small cap core. And this is our first active small cap ETF, and that's very much on the back of investor demand, asking us for, and this goes to something that Todd said earlier, everybody wants it in an ETF. Right, and so I do think that is a trend for next year as well.
Yeah, well, look, given the underperformance of small caps this year, some outperformance next year with mean reversion should happen, and yet it hasn't for a while. It's been, I keep waiting. I own a small cap value fund for years and years and years, because that's the historic strategies. Go back and talk to the what factors work. Small cap and value tend to outperform big cap and growth over long periods of time. Well, I've been sitting here for 15 years. Right. Waiting, and I own this fabulous small cap value that gets very high. It gets 5 stars on Morningstar, and it's still underperforming. And I keep waiting.
What's been going on for 15 years, though? I mean, I think about the world we've lived in, and I go back to internationally, the metaphor is you can't invest in a bad neighborhood, so you don't have to invest in every country. But the bad neighborhood for small caps has been free money. And if you think about the argument of negative yields and the dynamics also of flooding the market, your high duration stocks, growth stocks will outperform in that environment.
But high interest rates don't help small caps, do they?
No. Hopefully they're adjusting. That's why I think you need the active handle on there.
Yeah. See, this is what happens when you get 3 smart people in a room together and, me off to the side yelling at them. It's been a great discussion, guys. We have to go, unfortunately. That does it for this week's ETF Edge. My thanks to Brendan, Tim, and Todd. We've asked Todd to stick around and give us his thoughts on ETF trends in the final weeks of the year. Coming up on our ETF Edge podcast. Remember, though, you can see all of our shows, and I mean 6 years worth of it. That's how long we've been around on the show. etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.